welcome to another edition of the MDM podcast. I'm Mike Hockett, our executive editor. This episode is brought to you today by our upcoming virtual profitability summit, which is set for December 4th from 10 a.m. to 3 p.m. Eastern and is free to attend. It will provide 5 hours of profitability insights and best practices from 10 executives across 8 different distributors, along with a few consultants in the channel, helping equip you for margin optimization in 2025. Find registration and the event agenda at mdm.com. The 2022 merger of Lawson Products, TestEquity and GexPro Services into Distribution Solutions Group was one of the biggest market developments we covered that year. And now that the dust has settled, it's a good time to explore what DSG looks like today, why that combination happened, and what's on the horizon. So, this episode features my conversation with Brad Wallace, who is a partner of LKCM Headwater Investments, the largest shareholder of Distribution Solutions Group. Growing up in distribution, Wallace was integral to DSG's formation and its ongoing integration, so I had him explain the rationale behind the transaction and the subsequent acquisitions the company has made since. He also previewed what's in store for DSG in the near future and shared a private equity perspective on why distribution is such an attractive industry for investment lately and in the years to come. Enjoy. Brad, welcome to the podcast.
Thanks, Mike. It's great being with you today.
So to begin, can you give us a background of what your experience is in the distribution channel?
Sure. So for me, it really actually starts back in my childhood. I grew up with a father who actually ran a distribution company. He ran a food service business that it's kind of your classic story of graduating from college, joining the business, working on the warehouse floor, and kind of working his way to president at 36 years old and ultimately retiring at 53. When he joined the business, it was about a $10 million revenue company. And when he ultimately retired, the business was doing over $400 million in revenue. And today, 25 years later, I believe it's doing over $3 billion in revenue, still a privately owned food service distribution company. And so I grew up around it. So it was fun, seeing a high power executive, working for a business and growing a business and building a team. And so I had the benefit of seeing that. And ultimately, when I got to high school and college, I ended up working in the warehouse. A couple of things I learned from that is that number one, I learned how to be a great forklift driver, so I'm pretty good at that. And number two, if your last name is the same last name as the guy that runs the company, you have to work twice as hard to get respect from your peers. So great, valuable lessons that I learned growing up in terms of being an operator and seeing a actual distribution business get grown. Yeah. And for me, ultimately, when I went to college, my interests were really around finance and investing. And so I chose the finance route. And if you fast forward, 8 years after my career and kind of going down a more of a, investment and finance route for my career, I joined Luther King Capital Management. And Brian King was in the beginning stages of really building out the private investment efforts of what was a 25-year-old firm at the time, Luther King Capital Management, which was primarily focused on the public markets. And so Brian wanted to kind of build out the private investing efforts. We both shared a passion of really building businesses. We also shared the same belief that having operating experience certainly helps as it relates to being a good investor. And so I actually joined as a CFO of a business. So I have a couple of years of experience being a CFO, not of a distribution business, actually was retail. But that background and that experience certainly, I think, offers a different lens for me that's super helpful. And then shortly after that, I was asked to join the board of a distribution company by the name of Lawson. And Lawson was a specialty distribution company that basically distributed Parker instrumentation and valves. And so it was a great experience for us to, learn the distribution world, learn the inner workings of what it takes to invest in working capital and inventory and be a great conduit in the supply chain. And it also allowed us to start building a team around distribution. So we had 2 amazing executives there, the CFO and CEO, that we learned a ton from. We had a great board that we surrounded ourselves with that we learned a ton from. all of which we still work with today. We consider them part of our ecosystem. Today, we have them actively engaged in other distribution projects that we're working on. And so that was really the beginning of really what created a passion for us around that. And we kind of consider it a little bit of our jump shot. That's where we spend most of our time. I think over about 50% of our time and our capital is spent in specialty distribution.
So that's a really interesting career path, not only from growing up around the business, but with your father's role and then just your career path to where it led now. It's a real interesting combination of perspectives that I think you bring to the firm. So you touched on this, but anything more on how that combination of experience helped you as a leader when it comes to investment management and achieving earnings growth in the business?
Yeah. So, private equity honestly comes in all shapes and sizes. We've seen those that consider themselves allocators. They're allocating capital. They're taking a more of a passive role, and there's some that are more active. We consider ourselves to be more on the active side. We're definitely not wrench turners, but we try to provide the resources and the support to our leadership teams to really affect positive change in the businesses that they run. What we say is we want to leave these businesses better than the way we found them. So, so for me, being in that seat, being an operator certainly offers a perspective that may be different than others. And so there's an appreciation for the challenges that it takes to actually affect change inside of a business, being in that role. And we have a handful of folks on our investment team that also have operating experience, which certainly helps them. But it certainly has been super beneficial as it relates to building out distribution, because while some of us do have distribution experience, it pales in comparison with the operating teams that we surround ourselves with. So we've been very deliberate when it comes to our limited partner base as well as our operating partners, that they are active and resourceful for us. And so it makes us smarter and makes us better as it relates to investing and partnering with our leadership teams. We definitely are active and engaged. We have the benefit of, investing in over 100 different distribution businesses. And so seeing that from our lens and then offering those, both seeing those movies play out both positively and negatively, have certainly helped us be a better partner and better resource for the leadership teams that we partner with.
So Distribution Solutions Group is one of the assets that Luther King oversees here. So I'd like to get into the formation of Distribution Solutions Group and what that's looking like for you guys right now. So industrial MRO has always been one of the core distribution verticals that MDM has covered. So when it was announced at the end of 2021 that Lawson Products would combine with TestEquity and GexPro Services to form a new publicly traded distributor, that was really big news for our audience. And that deal finalized in the spring of 2022, resulting in Distribution Solutions Group. That was a unique combination in that it wasn't just an MRO distributor acquiring another MRO distributor. This was three distributors from three different industries merging to form a new parent company here. So can you take me through how those conversations first started and what the decision makers involved had to figure out in order to make that all work?
Wow. Yeah. Deep question there. There were a lot of conversations around that leading up to it. So you mentioned the spring of 22 we closed, but it actually started, when we sent the letter to the board in May of 21, where Brian King sent the letter to the board expressing an interest in combining the businesses. It even started several years prior to that, where Brian King, the chairman and CEO of DSG, had a vision of building a large specialty distribution business. We had witnessed several distribution companies compound their dollars over time as a public investor, since we largely are a SEC registered investment firm investing in the public markets and following those businesses. We wanted to do that ourselves. We had developed resources around us and our operating partners. We had developed an expertise in the area. And so Brian had a vision of building a compounding engine that allowed us to do M&A and invest in businesses and seek the highest return on invested capital opportunities within a single platform. Now, that vision it wasn't specific around Lawson and GexPro Services and TestEquity, But as we, were accumulating shares in Lawson and ultimately became, 48% shareholder in 2019, and Brian ultimately took the chair seat at that point, we got intimately familiar with the business and the opportunities ahead of us as shareholders. They had a war chest of capital with a balance sheet that was unutilized. We had done some M&A, but not a lot. And then we had the experience and perspectives of GexPro Services and TestEquity that we had owned for 2 years in the case of GexPro Services and 5 years in the case of TestEquity, that we found that by combining these companies, we could provide a more holistic solution to our customers. So it actually started with a customer intimacy question that we had on what can we do more for the customer base. And so we were touching a lot of the same customers. We were in the same plants. How can we create a more holistic offering? And so this was, we viewed this as an excellent opportunity for us to put these businesses together, have a balance sheet that allowed us to also have a wider aperture on M&A. So more opportunities for the shareholder base to add capabilities to the platform than we otherwise could if we kept these businesses apart.
So definitely a lot of intimate knowledge of these three businesses when they came together there in the spring of 2022. We're now more than 2 years since that merger finalized, but I know there's always the task of ongoing integration that, depending on the size of the merger, can take years for a combination of this magnitude. So with the dust now settled, can you share where Distribution Solutions Group is on that integration between the three companies and just how that process has been?
Sure. I think it's important to point out, I think we've been vocal about this from the beginning, about that we never really had an intention on really combining these businesses. So when you think about leadership teams, you think about ERP systems, the customer facing side of the businesses, we want to continue to keep them separate and distinct. Each of them offers a unique set of services and capabilities and go-to-market strategies that are too different to really put them together. So when you think about ERP systems and leadership teams and down to the Salesforce level, it's important to keep those separate. So integration for us has largely meant create best practices across the platform, create cross-sell capabilities and opportunities across them, and also create back office savings and sourcing advantages where you can. And that is ongoing. And it's kind of like a golf game. We can continue to get better at that. So it is an ongoing process for us. So was there a heavy lift? Absolutely. But was there a heavy lift as it relates to integrating ERP systems and integrating teams? Not so much. And that kind of made it, I would say, more simple from a quote unquote integration standpoint. It's also important to point out that we have separate and distinct teams from the LKCM Headwater standpoint that is actually working with each of these verticals. So there's a lot of initiatives that are ongoing between all three. But we're super happy with where that's gone. The partnerships between the three leaders, the cross-selling that is existing between the three is going better than we anticipated.
Well, making things more exciting, but also more complicated during this whole process was DSG's acquisition of Hisco, a fellow large industrial distributor of adhesives that the company purchased for $269 million upfront, and I think it was up to another $30 million in retention payments. How challenging was it to complete that Hisco transaction just after the initial DSG combination happened?
Sure. Yeah, Mike, they're all challenging, right? This was a more transformational and sizable acquisition for us for sure. We just completed some smaller acquisitions in the case of Tech Component Resources and Conres, which we may want to talk about in a little bit. But there's sets of complications with even the smaller ones as it relates to getting things over the finish line. So this was a business that we knew intimately for the last 5 or 10 years, and when they were trying to find a solution to unwind their ESOP, we were kind of the first in line for those conversations, and we felt like it was a perfect fit inside of the industrial technology platform inside of TestEquity. You see, they was largely kind of capital spend dependent, and so we were trying to find ways to smooth out the earnings base there to get more MRO, which Hisco certainly offered that. So it offered capabilities and products and services that were extremely complementary to TestEquity. But then, the lens we look through here is not only how does it benefit each of the verticals, but also how does it benefit DSG. So if you think about the geographic and customer diversity that this offered us, we felt like it was a perfect fit for effectively making DSG better. And so we're seeing that in terms of cross-sell. We're adding OEM capabilities that are cross-selling inside of GexPro Services as well as TestEquity's existing customer base. And then we're adding the geography in Mexico and creating expansion opportunities there across all three of the verticals. So it's doing everything that we anticipated. We anticipated having some cost savings as a result of this because it was a very similar platform as TestEquity. And so we've actually well exceeded where we thought we were going to be on cost savings there. And we're in the middle of, integrating that business into TestEquity. So as it relates to integration, we certainly feel like that's going to be one common platform that we're going to be operating under, particularly as it relates to combining ERP systems and Salesforce, et cetera.
Well, you alluded to this, but since Hisco, DSG has remained busy on the expansion front. Just this year, it has added Emergent Safety, S&S Automotive, and Source Atlantic to Lawson Products. It's added Tech Component Resources in Singapore for GexPro, and then Conres Test Equipment for TestEquity. Can you touch on why DSG came out of this formation so aggressively on the M&A front?
Well, yeah. So, in the 5 years leading up to the combination, we had done 9 acquisitions. So we were very active in that regard. We've done 10 since we formed DSG in the spring of 2022. And, our process continues to be to, rigorously evaluate opportunities for investments and then prioritize capital allocation. And so these acquisitions that we've done, we felt have basically made us a better business. It's not about financial accretion. It's more about capabilities that we can offer our customers and is additive to overall accretion to the DSG platform. And these are acquisitions that absolutely fit our investment mandate. We say no to many more M&A opportunities than we say yes to, but each of these have their own distinct way of kind of making our businesses better. So if you think about, Conres Test Equipment for TestEquity, that was a business that we were able to largely acquire a rental fleet for approximately what we bought a business for approximately what we could have bought that same rental fleet for. And at the same time, we added several customers and we added an earning stream and we added a lab at the East Coast that actually, added additional capabilities for our customers. Or in the case of Tech Component Resources, it took us into a geography in a country where our customers are going. And so following customers and having capabilities in a country that's very active in that particular end market for GexPro Services met all the underwriting criteria for us. As a reminder, also, we did not add a big infrastructure at the DSG level, but one of the things that we did do is we added a business development team, an M&A team that's actually actively looking for sourcing opportunities, but also processing opportunities as well. So this was deliberate on our part. I mentioned the wider aperture, but this is all about driving shareholder value. And so there's both organic initiatives that we're working on at all three platforms, but also inorganically as it relates to M&A. This is something that we feel like we're going to continue to pursue.
Well, alongside all those acquisitions, DSG held a 2-for-1 stock split in August 2023 and an expansion of its credit facility this past August from $805 million to $1.06 billion. So that definitely frees up a lot more cash. Can you share what those financial moves do in essence for the company?
Sure. The stock split was advice that we were kind of getting certain from the public market, didn't provide any different financial metrics for the business in terms of capabilities. It was purely to get more shares open in the float for more tradability of the stock. But in the case of the debt facilities, yes, certainly that JP Morgan has led that. We have a great bank group, has been incredibly supportive of us. We started with a $500 million facility when we closed in 2022. We expanded that to $800 million whenever we did the Hisco transaction. We did that alongside a rights offering where we raised $100 million to execute that or affect that transaction. And then when we closed on Source Atlantic, we expanded that by $200 million, as you mentioned. Huge support from the bank group, so it's been hugely supportive. And it's adding basically firepower for us. And so we have even additional firepower to leverage that debt facility in a way to do more M&A. We've been vocal about not getting over our ski tips on leverage, so we want to keep that between 3 and 4 times. It may spike up to the upper threes as we do a transformational acquisition like a Source Atlantic. But with 80% free cash flow conversion on EBITDA, we're able to quickly pay that debt down and create more debt capacity to do more M&A.
Well, all of that represents a tremendous amount of activity in a short period of time in terms of strategic decisions, which certainly takes an immense amount of coordination from the leadership team and having the right people in the right place to make that all go smoothly. So from a leadership organizational standpoint, how has DSG and LKCM Headwater Investments made this all work with all these moving pieces kind of happening at the same time?
Well, it certainly feels like a lot. I can see how an outside perspective it does, but you have basically 3 businesses with 3 different work streams, 3 different teams at LKCM Headwater that's working with the leadership teams at DSG with both organic and inorganic initiatives that are going on. So I can see how that sounds overwhelming. For us, it's part of what we do. I would say that there's kind of one word that comes to mind in terms of like making it all work, and that is alignment. So we have certainly, over 4,000 dedicated employees at DSG that with, we believe, the right financial incentives to drive shareholder returns. We have a leadership team that has basically their long-term incentives largely tied to shareholder returns. And then we have the LKCM Headwater team that's also largely tied to that. So, while most private equity firms, don't maybe have a lot of dollars committed to the fund, like, downside risk, we're a little bit different. About 30% of all of our capital actually comes from our team and our firm and affiliates. And so, like, for me personally, as well as several on our investment team, LKCM Headwater is our largest investment, and DSG is our largest investment inside of Headwater. So DSG ends up being our largest personal investment.
Yeah.
So we are aligned to not take fees out of the business, but we're aligned to drive shareholder value. That's how we get paid. And we like to align our leadership teams and our employees to that same level of interest. So I think if you're waking up every day and you're thinking about shareholder returns and you're thinking about how you want to allocate capital, and you think about what these initiatives that we're doing that are driving earnings growth in the business, that's what gets us up. It gets us fired up. And so having alignment is certainly, we think, the big driver to make everybody work well together.
Amid all of these strategic decisions and adding these pieces to gain scale and capabilities, I'm curious as to what investments or innovations DSG has infused into its operations, whether that's in the form of technology or somewhere else. Is there anything you can share about what the company has been up to on that front, or any plans in the near future when it comes to internal investments?
Sure. Yeah, it's ongoing. I can point to a lot of things that we've done up until this point, a lot of things that we have in the works. That's anywhere from, when we're making these 10 acquisitions that we've done since we closed on DSG. Each of them may have a disparate ERP system, so we're integrating those ERP systems into our own. We're rolling out new CRM systems in the case of Lawson Products today. We're thinking about ways to cross-sell better between the TestEquity and the Hisco platform. In the case of Lawson as well, they have a sales force and a go-to-market strategy that's existed. It's been the same for the last 72 years. Mike Takeda, who I know has been on your podcast before, did a phenomenal job. In the 9.5 years that he was there, he kind of came into that business with a lot of turmoil, I would say, a lot of changes that are going on. Stock was trading at less than $6 a share. This is a pre-split number. When he decided to retire, he drove it to $60 pre-split value. So tremendous effort on his part to build it to where he did. But as we entered into, DSG and we recruited in Cesar, we knew we were up against some, pretty significant changes. And that would be, territory optimization, technology improvements that we wanted to make, compensation alignments, all of which we knew were going to be disruptive, but were absolutely necessary. Anybody that's been in specialty distribution knows that that change is necessary. You can't operate the same way you have been for 72 years. And so our job at LKCM Headwater is to challenge the team and not only hold them accountable, but be partners with them and be thought leaders as it relates to making these changes in the business. We're expanding our commercial team at GexPro Services today. So yeah, we could spend a full podcast on specifically this topic because it's something that we think about every day. How do we make these businesses better? And there's always technology improvements and other initiatives that we can do to continue to drive value.
I'm sure you can't share real specifics on this, but looking ahead, can we assume that DSG will remain in expansion mode in 2025 and beyond?
Oh, certainly will. We definitely have throttled down to continue all the initiatives that we have underway and create new ones and create, other transformational M&A opportunities and add-on opportunities for us. We were vocal at this time last year during our investor day about our 5-year plan to grow it to, $450 million of EBITDA. We've said it's not going to be linear. If you think about this year, there's a lot of areas of our business that we're incredibly proud of, and there's a lot of our areas of our business that we need to work on. And we've seen the PMI numbers for the last 2 years have been below 50. Not sure where that goes. Don't have any predictions on where that goes in 2025. But despite where that goes, we need to be thought leaders, and we need to find ways to make each of these platforms better. And we have plans to continue to do that in 2025. We have a lot of optimism going into the year.
Well, looking broadly outside of DSG, M&A has always been one of the biggest market drivers in distribution, and we've seen an immense volume of activity over the last few years. As far as the markets we cover here at MDM, 2024 is going to end up considerably bigger than 2023 in terms of the amount of deals that end up being done here. And we know that private equity is behind a large portion of that. So what are your thoughts on the remaining appetite for distribution M&A from a PE perspective, and why is this such an attractive industry for PE investment?
Well, I would say it's attractive for us. It's an asset light model, which allows you to kind of redeploy your capital back into working capital that drives really high returns on invested capital. We don't see specialty distribution going away. The only reason it goes away if you're not adding value in the supply chain. So if you are having service capabilities, like you think about in the case of Lawson, which is a high touch VMI model, or in the case of GexPro Services, that's out sourcing 5% of the piece goods that go into manufacturing but represent 80% of the quantity of parts that go into it, there's always going to be a need for these service offerings. And so we don't feel like it's going away. And there's always ways that you can form better relationships with your manufacturing partners as well as your customers to add stickiness to that customer base. So it's definitely a sector that's becoming or has become a very interesting for private equity. The other piece of it is the fragmentation of the market. So yes, transaction volume is up this year. I see that continuing into 2025. I don't see any of that going away. I mean, there will continue to be consolidation opportunities that we'll be a part of, and there's going to be other private equity firms that have that same interest. And so I don't see any of that changing in the near future.
Finishing up, is there anything else about DSG that you want to share with our audience that maybe we haven't covered already, or anything about the company that our audience of distribution executives should know that maybe they otherwise don't right now?
Well, I can't offer anything that probably the listeners don't already know for sure. I think for us, one of the things that we say is that is that people matter, right? So when you think about our over 4,000 dedicated employees and our leadership team, those are the people that we try to support, and you support them, and they ultimately help you achieve your objective of driving shareholder value. So that we can't lose sight of the fact that it's the people that drive value. Kind of circling back to my father's experiences, I remember him being this president of company, but he's like so focused on the personalities that are on the street and the people that he's hiring. I mean, had a large sales force, and like that stuff matters. And so we need to create, we need to continue to create opportunities of fun and exciting ways to attract talent. And we're super happy with the talent that we do have and want to continue to support them. But look, I mean, I think in closing for us, it goes back to alignment. It goes back to figuring out ways that we can be as supportive of partners as we possibly can to our 3 leadership teams at TestEquity and Lawson Products and GexPro Services. And we wake up every day fired up to do what we can to help in that journey. So, Mike, appreciate today. This is great.
Yeah, thanks for all the perspective and just insights you shared here with our audience. So, Brad, thanks one more time for joining the podcast.
Thank you.
Thanks for listening to the MDM podcast, which was brought to you by our 2024 Virtual Profitability Summit, set for December 4th from 10 a.m. to 3 p.m. Eastern, and is free to attend. You can find all of our past podcast episodes at mdm.com/podcasts and wherever you listen to podcasts.